All you hear these days is invest, invest, invest. Hi, it's Tracy, and in this video, we're going to go over the investing mistakes that beginners make. Because yes, we are humans, and we make mistakes. So learn from me and others and avoid them. Share the love and subscribe to a new channel, and let's chat. Mistake number one, which is by far the most common mistake that I see people making, is simply not investing at all. And I get it. I used to make this mistake, and it took me longer than most people to invest because it feels safe to have all your money as cash in the bank. Often cash just gives you that really nice sense of financial security, which is why many people do it and why I did it. But keeping all of your money as cash is a big mistake, and here's the reason why: inflation. You need to invest to beat inflation because inflation is eroding the purchasing power of money over time, and investing in assets that historically outpaced inflation, such as stocks and real estate, can help you preserve and grow your purchasing power. This will ensure that your money retains its value and you can buy more in the future. If your money is not growing at a rate that is faster than inflation, you are losing money. Moving on to mistake number two, which is not having an emergency fund before you start investing. You hear me talk about this a lot in my other videos, but it's so important to establish an emergency fund before investing, and it's generally recommended as a foundational step in personal finance. So it's really important to have cash that you can access if you do get hit with an emergency expense like being sick or car repairs, because this stuff does happen, and myself is no exception. I just had to get my car window fixed after a freak accident on the highway. So once you've established an emergency fund, then you can consider investing additional funds for your long-term goals, such as retirement, education, savings, or just wealth accumulation. So this approach is going to help ensure financial stability, risk management, and create that solid foundation for your future investments. Basically, to sum it up, you don't want to be in a place where you have to sell your investments early to get the cash to pay for your emergency expense. Mistake number three is just investing too much money at once. If you're a beginner or new to investing, you should really start with a small amount of money when you figure it out and get used to all the market's ups and downs. So again, as a beginner, consider starting with a small amount of money that you can comfortably invest with without compromising your financial stability. Many investment platforms will allow you to start with a really low minimum. So decide on a starter amount that doesn't stress you out and then add more and more. Basically, try not to shock your emotional system. Now let's move on to mistake number four, which is not considering taxes. You need to invest with taxes in mind. So when you're considering investment accounts with tax advantages, there will be several different options that will cater to different financial goals and tax situations. Use these accounts to help save money on taxes. Typically, if you're investing, you have to pay taxes on things like your dividends and capital gain tax on any profits. So if you pick the right accounts, you will save your money. For example, one of the best investing accounts for tax benefits is simply a Roth IRA. Any contributions to this Roth IRA are made with after-tax dollars, so they are not tax deductible. The qualified withdrawals or earnings in retirement are tax-free. Also consider a health savings account. Now these are available to individuals with high deductible health plans. Contributions are tax deductible and withdrawals from qualified medical expenses are tax-free. So they really offer triple tax advantages. You have a tax deductible contribution, tax-free growth, and tax-free withdrawals for medical reasons. Another mistake, which leads us to number five, is chasing hot trends. Investing in trendy or speculative assets without understanding the fundamentals or long-term prospects can lead to losses. Basically, you don't want to avoid chasing hot stocks, sectors, or investment fads without conducting your due diligence. If you don't know what I mean, chasing trends in stocks is basically just referring to the practice of investing based on popularity or recent performance of specific stocks, sectors, or investment themes. While it may be tempting to follow these hot trends in the market, this approach can lead to several different pitfalls and risks. My last mistake, which is number six, is lack of diversification. Failing to diversify your investment portfolio across different asset classes, sectors, industries, and geographical regions can expose you to a higher risk. You need to diversify to help reduce the risk by spreading across multiple investments. A diversified portfolio is typically less volatile than a concentrated portfolio. Plus, this will aim to achieve more of an optimal balance between your risk and your return, which is why some investments underperform while others outperform, which will contribute still overall to your portfolio growth. This will allow you to capture the upside potential while still managing the downside risk. So, if you're investing or looking to invest, try to avoid these mistakes. Yes, I have made some of these mistakes before. So, let me know where you are in your investment journey in the comments down below. And yes, I do read these comments. Thanks for supporting a new channel. Much love, much thanks, Tracy.